So I recently got asked, what are bonds and how can you buy them? So in this video, I'm going to be explaining in simple terms what bonds are and how you can buy them if you're here in the UK. So essentially, bonds are an IOU between you and typically the government or another institution that is trying to raise money. Essentially, you are lending your money to this institution with the hopes that you will gain interest on this amount that you've lent. So when buying a bond, there will be an agreement at the start of purchase that will set the conditions of the bond and how the payments are paid out. When considering buying bonds, there are a few terms that you need to note. For example, bonds will have an agreed interest rate. This is called the coupon. Typically after the bond is issued, this coupon should not change. So when you buy a bond directly from the bond issuer, the amount you pay for it is called the face value, and most bonds have a face value of around $1,000. So after you purchase a bond, at the end of the bond agreement date, you will get back the face value, and the duration between buying the bond and the end of the agreement date is called the maturity date or the maturity period. So when bonds mature, the agreement ends and the bond therefore expires, and at the end of maturity, you will get back the face value of the bond. So you might be asking, why on earth would you buy bonds? The purpose of buying a bond typically is that interest is paid out regularly. Usually this interest is paid out biannually, so twice a year. However, you have to look in the small print because it will depend on the terms of agreement when the bond is actually issued. So most people will hold bonds as it is technically a guaranteed way of making money throughout a certain time period. For example, if you are looking to retire soon and you hold a portfolio of stocks, you might want to diversify into having less stocks and more bonds, because bonds over a longer period of time will ensure that when it comes to retire or taking your money out, you will have a less bumpy ride when the stocks are very volatile, and that will give you a more consistent income. So unlike stocks, bonds do not give you any ownership over the company, meaning that you won't benefit from increases in the company's bottom line, for example. And compared to stocks in the long term, bonds will typically not pay as much interest as stocks tend to do. So as with anything in finance, you are paying more or less based on how much risk there is. So bonds technically have a lower risk value compared to just investing in stocks, and because they have a much lower risk, they also do tend to pay out overall less than stocks. So in order to receive all the money plus interest from a bond, you should hold the bond for the entire duration until it reaches maturity. So bonds can go all the way up to a 30-year term. Generally speaking, the shorter the term until maturity, the lower the interest rate that you're going to get, because this is a reflection of how much risk you take. For example, a bond that spans over 30 years is going to show a lot more risk because the interest rate within those 3 decades is very likely to be going up and down, and therefore will be a reflection of the risk. So with longer terms, there is a greater risk of default on the debt. However, it's very important to understand that different institutions will have different credit ratings. So an institution that has a very high credit rating, for example a government, will tend to give less interest on their bonds. However, there is less risk that they will default, and if push comes to shove, for example, governments can always raise the taxes in order to pay off these bonds. So with some companies that do not have a high credit rating, they can offer very high interest rates on their bonds to be more attractive in the bond market. However, there is greater risk that they will default on the debt and that you will not get all your money back. So in the UK, government bonds are also called gilts. This is a reference to the time where they used to be printed on paper surrounded by golden gilded edges. So the United States Treasury bonds are technically the safest bonds in the entire world. This is because the United States has never defaulted on its debt and is currently in the best financial situation out of any other country in the world. So with government bonds, you will typically buy them directly from the government website, but these typically have very high costs, and I don't think many people will actually buy the bonds from the government website. So stocks and bonds are often always thought about together. This is because they can both be traded as securities. So just like with stocks, you can buy and sell stocks in the market. If you own a share in Apple, for example, you can sell it to someone else who will buy that share off of you to benefit from rising or decreasing prices. So just like with stocks, bonds can also be sold after you purchase it. This is called the secondary market, and it's not just directly from the issuer. So once you buy a bond, then you can sell it off into the secondary market. So the secondary market is where the majority of retail investors will actually buy their bonds from. Because after a bond is issued, the coupon doesn't really change. The market conditions, however, do change after the bond is issued, and this changes the value of the bond in the secondary market. For example, in high interest environments, new bonds that are issued by either governments or institutions now have a higher coupon. So this means that older bonds in the secondary market are now worth less to investors because they pay out less interest. So another key term to know about bonds is bond yield. So the bond yield is calculated simply by dividing the coupon by the price of the bond. So these bond yields will fluctuate over time. Higher bond yields means that the price of the bonds actually fall, so they're inversely correlated. So when stocks are doing well, bonds are supposed to go the other way. This is why we use both stocks and bonds to create a portfolio that can provide us constant income when we are looking to withdraw our money and retire. So bonds are said to be a hedge against inflation. This is because when inflation is high, the central bank increases their interest rates. With high interest rates, bonds now pay more interest, meaning that bonds become more attractive as a place to put your money in during times of hardship, rather than putting your money into the stock market, which can often give you a negative return. So now let's see what we would find if we typed into Google how we can buy bonds in the UK. So if we type into Google buy bonds UK, we will be given first of all just sponsored cards, which I tend to ignore. And the first thing that we see is Hargreaves Lansdown, which has been around for years and is a very trusted UK based provider for stocks and bonds. So if we go into Hargreaves Lansdown, we can see there is a section on bonds and gilts, and we can actually view bonds and their prices. So in this page we can see corporate bonds. So these are bonds issued by corporations, and as we can see here, we have the issuer, we have the coupon amount, which is the amount of interest paid during the duration, and the maturity date to when the bond expires and the face value is given back. So for example, if I go to the first one, we can see from the 3i group we have this bond here. You can see that we can buy and sell these bonds. So this is more than likely that this bond is in the secondary market. This is because the price is changing already. So when a bond issuer actually issues a bond, it will have a fixed price. As you can see in the year, it's had a high of £115, and in its previous close, it's been around £96. So at a glance, we can see that this bond was issued by the 3i group, which I've never heard of. And the structure of this bond is fixed income and fixed rate, which is what you'll see the majority of the bonds, and the coupon value is 5.75%. So this is the annual interest made to the holders during the duration of the bond, and the coupon frequency is biannually, so you'll be receiving these payments twice a year as long as you hold the bond. So as you can see, the issue price was around £100, but since then that has fluctuated. It has increased and then it has decreased because the environment of interest rates has also changed. At one point the interest rates were much lower than they were now, meaning that the bond's value probably would have gone up because the bond was more attractive as a means of generating more interest. So by holding more of these bonds in your portfolio, you can receive a more steady income from these bonds. However, unlike stocks where the capital appreciation can really make you more money, bonds are very unlikely to keep going up. They're very cyclical, so they will change based on the interest rates. And overall, you're just holding bonds just to smoothen out your income withdrawal when holding a portfolio for retirement. So as you can see, each bond will have a different maturity date. The closer you are to maturity, the less time you actually have to hold it, and as a result that will give you less interest. So as you can see, there are many corporations issuing bonds, but it's very important to know that each corporation will have its own credit rating. So it's definitely up to you to consider all the factors, including credit rating, the coupon rate, the maturity. Everything has to be put into your calculations in order to decide whether or not these bonds are the right for you. Of course, any of these companies could go bankrupt, meaning that they might have to default on the bonds, and as a result they might be paying more interest to cover up for that risk. But if worse comes to worse and the company goes into bankruptcy, even though as a bondholder you are bound in a legal contract from both the issuer and yourself, meaning that they do have to pay you back, but if worse comes to worse, there will be quite some time and procedures that have to be played out. You know, the company's assets have to be seized, and your money as a bondholder will be prioritized over someone like a shareholder who actually has very low priority in ever getting their money back, when it comes to bankruptcies. So for example, many companies that Hargreaves Lansdown offers, for example, Anglian Water, we have Aviva, we have Bank of Ireland, many different banks like Barclays. So if you did want to buy from here, for example, that is definitely something that you could do. Furthermore, to add to the confusion, there is this thing called the premium bonds, and I've talked about premium bonds quite a few times this week on the channel. It's one of the UK's favorite savings product, and essentially these are bonds. So these are actually government bonds provided by the Treasury, so they're very, very secure, pretty much one of the safest bonds that you can get. However, they're not like the other bonds. Currently they're providing 4% annual price fund equivalent rate. However, this is not guaranteed person to person. The way premium bonds work is that yes, they are a bond. However, instead of giving the money out normally like they would do, so 4% annual equivalent to each holder of the bond, they instead give out prizes to certain people, so a very select few, some winning £1 million, some winning 100,000, some winning £50, some even winning 25, but the majority of people don't earn a single penny. That's just the way it's designed. So if you're looking for a guaranteed way of making money, premium bonds is by far not the best option. You can also buy bonds directly from banks, for example Barclays. Here they have a 1-year fixed rate bond, and that's paying 3.8% annual equivalent. You can also find things like a 2-year bond giving a 3.9% equivalent. So generally with a longer term date, you're going to be earning more interest because of the risk, and you're locking your money up for a longer amount of time. So if you look at Raisin, which actually compares many different bonds, we can see that bonds can be issued by a number of different banks. For example, this bank here, Al Rayyan Bank, is FSCS protected too, and it's giving a 1-year bond giving you a 6% annual equivalent. However, it's very important to always look at the terms and conditions, because sometimes the amount you can deposit is going to be limited, or the minimum amount you have to put in is going to be quite big. So for example, this one here, the minimum amount you can deposit is £5,000, and the maximum amount is quite good at £85,000, which is the FSCS limit anyway. So if we actually go into Raisin, we can actually find a Barclays bond which is giving a much better return. If you don't want to use Al Rayyan, you can use Barclays, and that gives out a 5.85% annual equivalent rate. Again, please always do a research before buying any of these products. At the end of the day, I am just a random person on YouTube. Anything that I do say, you have to do your own research, because I will sometimes make my own mistakes, and I do apologize for that, and I will go and fix them, but I'm just giving you the headline things. You should always go and check and do your research from very reputable places. Also, if you are using apps like Trading 212, Free Trade, and so on and so forth, you can actually invest in bonds through ETFs. So here, if I type in bonds, you can see that there are a number of different bonds that we can buy, and some of these are ETFs. So the majority of these will be ETFs. For example, if we just go into something like random from Vanguard, for example, European government bonds, we can see that this is an exchange traded fund that tracks the performance of the Bloomberg Barclays Euro Aggregate Treasury Index bonds that have maturity dates over 1 year. And as you can see, compared to this index, the bonds have been falling in price. This is because the interest rates in Europe have consistently just kept going up and up, meaning that older bonds are less favorable because you can just go to the government and buy newer bonds that are going to give you guaranteed money more. So why on earth would you be buying it from the secondary market? So make sure to check out some of my other videos, and I will see you in the next video.